Hi, it's Dre Griggs of Obsidian Wisdom. Today we answer the question, how is Social Security taxed in retirement? Now, you and I both know it would probably make the most sense for Social Security to not be taxed, right? Like we've already paid into the fund. The money we're just getting back is money that we paid in, but the government does not feel that way. In fact, you will see in this video that the government is pretty interested in taxing our Social Security, and it's very easy to actually fall into that. This is actually pretty surprising for most people. Most people don't expect their Social Security to be taxed, but we do know that there are some states that won't tax it, but we know on the federal level is what we're going to focus on today. And then you could always feel free to look into your own individual state to see whether your state taxes your Social Security. But here in Florida, for example, we don't have state taxes, so then you don't have to worry about it from a state perspective. And because taxes tend to be a little bit on the complicated side, I put a case study together with some slides so that you can see the numbers and maybe it'll make it a little bit more digestible. And so we will go ahead and discuss that information. I think I'm probably okay up here on the top left corner. I don't think I'll be in the way. All right, so I put us a case study together. So we have John and Mary Smith. John is 65, he's a retired engineer. Mary is 63, she's a retired teacher. They both live down here in Florida. They have 1.1 million in combined retirement savings. They both have a pension. John receives $30,000 per year from his pension. Mary receives $15,000 per year from her pension. And their annual Social Security benefits between the two of them is $55,000. John will receive $30,000, Mary will receive $25,000. And then they have other investment income of $10,000 per year. When you're looking at the overview of Social Security taxation, we'll go ahead and start with the basics. Not all Social Security is going to be taxable. Whether your benefits are taxable depends on your combined income and your filing status. So your combined income is your adjusted gross income, that's your AGI, plus your non-taxable interest, which for most of you is going to be like a municipal bond. If you invest in different state projects, that money is generally going to be received tax-free, plus half of your Social Security benefits. And when you add these together, this is what's called your provisional income. And I put the chart here so that you're able to see it, and we'll refer back to it as we go through the video. You can see that it's not very difficult to find your Social Security tax. If you're single or head of household, if you make more than $25,000 a year, inside of your entire retirement plan, which could just be your Social Security if you really think about it, then half of your Social Security is going to be eligible to be taxed. And then you can also see that if you make over $34,000 as a single individual, up to 85% of your Social Security is eligible to be taxed. So you can see that it doesn't take a lot. And if you're joint filers, if you go from a per person basis, is actually even less, where anything over $32,000 but under $44,000 is going to be eligible for that up to 50% tax. And then anything over that $44,000 if you're filing jointly, up to 85% of that can be taxed. Now, when you look at your provisional income, so we'll say John and Mary have $55,000. And the way that we calculate that, if you remember, is we basically took the annual pension of John, which is $30,000. We took the annual pension of Mary, which is $15,000. And then we took their other investment income of $10,000. So that's how we got to that $55,000. And then they have $1,000 in non-taxable interest. So they have $1,000 in non-taxable interest. So they invested some in municipal bonds to lower their overall tax burden. And then their Social Security benefit is $55,000, which you remember was $30,000 for John and $25,000 for Mary. So that was at $55,000. And then you half that. 55,000 divided by 2 is $27,500. And so their provisional income, you would add that together. So it'll be the $55,000 AGI plus the $1,000 non-taxable interest, plus the $27,500 of Social Security benefits. That would give them a provisional income of $83,500. And then we'll come back to that chart as I told you we would. So now we're going to look at what our thresholds of taxation is. And you can see that if you look at that $83,500, we are over that $44,000 for the joint filers. But it's also important to know that it really is very easy as far as being a married couple to be over that $44,000. Even if we just had their normal AGI of their pension, they still would have been over that, even if we didn't add anything else in there. But when you add half of your Social Security income onto whatever your pension or your investment income or your interest income, whatever your income that you're calculating is. So let's go ahead and calculate John and Mary's Social Security income tax. So we have to determine our taxable portion. So we would take that $55,000, which is how much we receive for Social Security. We already saw that we're over the $44,000, so we would be expecting 85% of that to be the taxable portion, which is $46,750 of that $55,000. We will then add it to our AGI. Remember, AGI is the $55,000. That is both of our pensions and the $10,000 that we received in investment income. So you have the $55,000 plus the $46,750. That will put us at $101,750, and that will be considered our taxable income. And all we have to do now is apply whatever be our appropriate federal tax rates to this amount. And I went ahead and put up the 2024 tax brackets for you to be able to take a look at. You can see we have the 7 brackets, 10% to 37%. And you can see what it would take to fall into each of these brackets. Now, it's important to know, and I do have another video, and I'll put a link to it for you, where I go into a lot of detail as far as ways to make sure you limit your taxes in retirement. But you do want to look at how difficult it is to move from one bracket to the other. I always note this with each of my client meetings because a lot of times the thought is, well, back in the day, we put all our money in a 401k and I had that $100,000 of income, and that would have been taxed in the 80s at maybe like 60%. And then when I retire in 2015, I'm only going to pay 22% taxes on that because, as you can see, I'm not making the $100,000. I lowered my brackets and now I'm at $80,000. Well, you can see that that would have worked really well. You would have went from 60% to 22%. The issue that I always want to know, and that's important, and you probably noticed it, whether you were at $100,000 or whether you were at $80,000, you would have been in the exact same tax bracket because we only have 7 brackets now, which means that that strategy might actually open us up to possibly paying more taxes in the future if they ever look at raising the tax rate. Now, if you've ever looked at the national debt, then you know that there's probably something that's going to have to change. I think we're over $34 trillion. We're moving into $35 trillion, where it's just getting really crazy, where it's just fake money out there. And so it's something that we do always want to keep in mind, where if you're just doing what we've always done, which is, hey, I'm going to invest 20% of my money and then I'm going to retire and I'm going to live off of 80% of my income, and now I'm going to be in the lower tax bracket. Well, that's not something that's as easy to do in 2024 as it was back in the 1980s. And as far as calculating what John and Mary's taxable income will be, it's actually going to be done on a prorated basis, and I will show you what that would actually look like. And basically what I'm saying is you're going to have the 10% bracket, which is going to be the first $23,000. So you times that by the 10%. And so we would pay $2,320 based on that $23,200. That's the first amount that will be in the first bracket. And then you see in our second bracket is 12%. So then we would subtract $94,300 minus the $23,200. That will leave us with $71,100. That amount would be taxed at the 12%, which would be $8,532. That's what we would pay in taxes on that amount. And then that third bracket is going to be 22%. And what we'll do is we would take $101,750, subtract that from $94,300, and that would give us $7,450. And then we multiply that by the 22% tax bracket, which will be $1,639. And then you would add together each of those amounts from each of those brackets. So you add the $2,320 from the 10% bracket, plus the $8,532 from the 12% bracket, plus the $1,639 from the 22% bracket, and then you would expect to pay $12,491 based on having that taxable income of $101,750. So that's what we would expect to pay in taxes. And as you're looking for strategies and tips on ways to minimize your taxes, well, there's basically 3 quick strategies that you can use in this video. And as I mentioned, I have the other video where I go through, I think it's like 9 of the strategies. But number 1 is you just manage your provisional income. So we might not want to take all of our income on those early years because it's going to increase and move us into higher tax brackets. Maybe we can delay Social Security on those early years where we're just using our taxable income. And maybe we can do some Roth conversions on some of those lower years, so that way we don't have those required minimum distributions to worry about later on, which could also push us into a higher tax bracket. And if done the right way, what we might be able to do is we don't have all of these incomes together. So we don't have our taxable income with our pre-tax income. That's the money in your 401k, your 403b, your Roth, and other pension plans. And then we have our after-tax income, which is our investments, our real estate income, our business profits, where we're not going to take all of these income streams at the exact same time. That might push us into that 85% bracket. Now, as you've seen, it's very difficult to not have a portion of your Social Security taxed, but we at least want to work our strategies in a way where we ensure our provisional income is not so high that we're paying taxes on money that we're not even spending. Well, we're able to have our money allocated in a way where we don't have to use all of our income streams at the same time, but we're only using the income that we need because we want to take these trips where we know what our goals look like and how much they cost. well, that could keep us in a lower tax bracket without unnecessarily having to give Uncle Sam more money. Obviously, he'll be very thankful for that, but if we don't have to, then there's no reason to. Number two is you would use your health savings account and your Roth. And I talked a lot about health savings accounts. We talked about that as a triple tax benefit. You could put the money in tax free, the money can grow tax free. And if you use the money on a qualified healthcare expense, that money will also be distributed tax free, which is a pretty cool strategy as far as being able to pay for some of these healthcare expenses, which we know on average is about $355,000 over the life of your retirement. Not to mention that 7 out of 10 people 65 and older have at least one long-term care episode. And if that is going to happen, we know that long-term care is normally going to be about $40,000 to $50,000 every single year, and it's normally on average 3 years. And so it may not be 3 years altogether, but on average about a 3-year span of needing long-term care services. And so you can use your health savings accounts to pay for that. And also that money inside of there is going to not count against your overall provisional income. Same with the Roth account, that's tax-free money. You've already paid taxes on that. Any income that you receive from that also won't count as a part of your provisional income. And so you're able to keep it lower while not necessarily lowering your lifestyle. And then third one is, of course, you talk to a professional. As far as your financial planner and your CPA, and I did say and on purpose, because you don't want to have one or the other. We work very well together, and we can come up with great tax strategies where we're able to coordinate some of these withdrawals, and we can do tax loss harvesting and all these other strategies. Tax loss harvesting, without going into the weeds, is a very fancy way of saying, if you have some income that's being generated passively, maybe we can offset some of that income with some losses that we've been holding on to, where instead of you paying taxes on all that income, maybe we can take in some of those losses so that you pay a lower taxable amount. That's all tax loss harvesting is. And so we're able to put the most tax efficient withdrawal strategies and other strategies together to ensure that more of your money is in your pocket and less of it is in the government's pocket. In closing, understand how your different income streams in retirement can be taxed can be a game changer, because you might believe you have enough income, but if you're not taking taxes into consideration, you might not have as much income as you believe as far as going in your pocket to fund your retirement lifestyle.